Investment is a smart strategy in placing funds so that they are not eroded by inflation. For example, investing in stocks that can generate high profits. However, high profits are also in line with risks. There are two ways to profit from stocks, namely trading and investing. Do you understand the difference between the two? The analogy of investment is similar to a marathon and a sprint. Marathon runners cover a long distance of about 30 kilometers, while sprint runners only need to cover a distance of 100 meters. At first glance, these two sports seem the same, namely running towards the finish line. However, there are important differences besides the distance. Marathon runners must maintain a steady pace to maintain stamina until they reach the finish line, while sprint runners use all their strength to run as fast as possible in short distances. Investing and stock trading are similar to marathons and sprints. Although both aim to profit from stocks, investment and trading have significant differences. Here are 4 main differences between investment and stock trading that you need to know. Time. Investment is the activity of buying assets with the hope of getting profit in the form of an increase in the price of the asset or fixed income in the future. Meanwhile, trading is the activity of buying and selling stocks. Investors tend to buy stocks that perform well and hold them for a long period of time, even more than 5 years. In contrast, traders treat stocks like commodities in the market, buying when prices are low and selling when prices rise, in a monthly, daily, or even hourly period. In stock investment, short-term market fluctuations are not the main factor. Investors are often happy when stock prices fall because it can be an opportunity to buy stocks at a low price. Meanwhile, for traders, market fluctuations greatly determine the amount of profit that can be obtained. Risk. Both stock investment and trading certainly contain different risks. Investment risk is often said to be smaller because it has the potential for low returns in the short term, but in the long term, the potential profit that can be obtained can be very large. Meanwhile, trading has a fairly high risk in the short term because market fluctuations are influenced by many things, such as transactions in the capital market, commodity prices, and so on. However, the potential profit that can be obtained through trading is certainly greater than short-term investment. There is passive income that can be obtained through investment. When someone decides to hold shares for a long period of time, then not only capital gain, increase in share price can be obtained. There are still several other benefits that can be enjoyed, such as dividends. When an issuer records a profit, it is likely that they will also distribute dividends to their shareholders, including you who own these shares. In addition to dividends, investors can also get other benefits when there is a corporate action by the issuer concerned. This one benefit, of course, cannot be obtained by traders who make short-term purchases. The purpose of buying shares. When someone wants additional income in the short term and has a large amount of cold cash, then trading can certainly be an option that can be considered. However, a trader is required to be observant in observing stock price movements in the market and master technical analysis. When a loss occurs, the risk mitigation that is carried out is a stop loss with a predetermined calculation in order to save capital.